What do the 2024, 1999, and 1987 stock markets all have in common? Each of these were at the heart of spectacular stock market melt-ups, providing ridiculous market returns to investors. And all of these melt-ups had a set of very specific conditions that were in place that were driving these exceptional returns. And we believe that these conditions are very much intact today, despite the recent pullback that we've had on the SP 500. In fact, at Bravos Research, we used this pullback as an opportunity to initiate a leveraged long trade on the SP 500. In both 1999 and 1987, the financial stars were aligned for the stock market to move higher. These stars are what we call financial conditions, and these very same financial conditions are once again extremely favorable to stocks rising today. These have a huge impact on both economic growth and how investors are participating in financial markets. And the three main financial conditions that we pay attention to are currently flashing big bullish signals. The first one is US interest rates. This is a chart of the 2-year government bond yield, which is basically showing us the interest rate that you can earn for holding cash over time. And as you can see, throughout 2025, this interest rate on cash has been decreasing. Now, it might not look like much, but this is a 50 basis point drop in the interest rate on holding cash, which can have significant consequences on financial markets. Since November of 2022, every single time that the 2-year yield has dropped like it is today, it eventually provided the fuel for a large stock market rally. Cash and stocks are always competing with one another to gain space in any investor's portfolio. And when the interest rate on cash goes down, it makes it more likely that investors are going to allocate a greater part of their portfolio to stocks instead of cash. And that could push the price of stocks higher. After all, if the interest rate you get for holding cash is 0.1%, which was the case in 2020 and 2021, for example, that doesn't provide much incentive for you to actually be holding lots of cash. So the chances are in this type of environment, you're going to see investors allocate a greater portion of their portfolio to stocks instead. If all of a sudden the interest rate on cash jumps up to 5%, that provides a lot more incentive to allocate to cash. That's what happened in 2022, which was the primary driving factor behind this 25% correction we saw in the stock market. Today, we're seeing the interest rate on cash fall, which mechanically should put upwards pressure on the valuations of the stock market. We can zoom out to a historical chart of the 2-year yield and see what happens to the valuations of the S&P 500 against this interest rate. Every time that the interest rate falls, it's accompanied by a rise in the S&P 500's valuation. In fact, if we flip the chart of valuations around, we can see that the two are incredibly connected to one another, showing us just how much of an impact the yield that we get for holding cash has an influence on how the stock market is priced. The only exception was here during the 2008 financial crisis, where the Great Recession completely ruined investors' confidence in the stock market. Now, some of you might be wondering, couldn't something similar happen this time around? If the US economy is heading into a recession, could interest rates fall and stocks still go down just like during the financial crisis because the economy is going into a downturn? Well, that brings us to the second key financial variable that has become very favorable today, and that is the price of oil. Oil prices have fallen by 20% just over the last couple of months, and they're now hovering at around the lowest levels in over 4 years. Now, why is this important? Because if we zoom out to a long-term chart of oil prices and shade in all of the official US recessions that have occurred since the 1970s, we see that almost every single downturn over the course of the last 50 years have been preceded by some kind of a big rise in oil prices. The only exception to this is COVID-19, which was a recession evidently triggered by the pandemic. Now, this makes sense. If oil prices rise significantly in a short period of time, it immediately makes the cost of living for most people jump up, and that makes it more likely that they'll be pulling back on their spending, potentially leading to a recession. But rising oil prices also means that manufacturing and transportation costs go up for businesses. So rising oil prices also makes corporate profit margins shrink, which can often lead to companies laying people off. Falling oil prices, on the other hand, have the exact opposite effect. It increases consumer spending power, it decreases manufacturing and transportation costs, making corporate profit margins expand, and so more likely to hire new workers. The decline in oil prices that we've seen since June of 2022 has been one of the key driving factors behind this stock market bull run. And if we rewind to the late 1990s, we see between 1996 and 1999, oil prices were also falling substantially, which was also a key driving factor behind the stock market bull run from the late 1990s. 1990s. Rewinding to the 1980s, we see that oil prices were also falling substantially during that period, which likely contributed to the exceptional performance of stocks. And in both cases, when oil prices began to rise substantially, shortly afterwards, the end of the big bull market came to an end with the Black Monday crash in 1987 and the peak of the dot-com bubble in 1999. Today, the continued downtrend in oil prices could be suggesting that the big melt-up in stocks is not yet done. And by the way, our narrative would be completely different if oil prices were trending up significantly right now. So we have falling interest rates, falling oil. Now, what's the third financial condition that could continue pushing stocks higher? It's none other than the US dollar. The US dollar index between January of 2025 and March of 2025 has weakened considerably. In fact, the US dollar has just witnessed the largest 4-day drop since November of 2022 and May of 2020 that both marked the very beginning of major drops in the US dollar. So the US dollar is weakening relative to other global currencies. And there's a few reasons why this has very important implications for financial markets and the economy. Firstly, a lower US dollar makes goods that are produced in the United States cheaper to the rest of the world. Let's take a scenario where $1 equals €1. A car produced in the US costing $50,000 would cost 50,000 euros to Europeans. Then all of a sudden, the US dollar weakens by 10% relative to the euro. That same $50,000 car would now cost 45,000 euros. So US produced cars suddenly become more attractive for Europeans to buy. This is what happens when the US dollar weakens, but not just for cars, for all US products, and not just for Europe, for the entire world. This is a very direct mechanism through which a lower US dollar has a stimulative effect on the US economy. And we can see this happen very clearly throughout history by looking at a survey called the ISM PMI that measures the US manufacturing sector's performance over time. This shows us the ups and downs in the manufacturing economy in the US. And if we add the US dollar on top, we see that the two have a very clear inverse correlation. When the dollar goes up, the manufacturing sector typically slows down. When the dollar declines, manufacturing typically picks up. If we flip around the US dollar, we see this correlation even more clearly. So a big decline in the US dollar right now would likely have a stimulative effect on manufacturing activity in the US. And if we look at what happens to the stock market during cyclical pickups in manufacturing, the SP 500 typically performs quite well. So that's the impact the dollar can have through the economy. But it also has a direct impact on how the stock market is priced. The reason for that is because 41% of the S&P 500's revenues come from abroad. So that means that 41% of the S&P 500's revenues are denominated in other currencies than the US dollar. A weakening dollar means that other currencies are strengthening against the dollar. When that happens, it mechanically makes that 41% of revenues bigger. Again, let's take a hypothetical scenario where $1 equals €1. A US company that makes 100 million euros in revenues in Europe will report $100 million in revenue in its earnings call. But now all of a sudden, the dollar weakens by 10%. That same 100 million euros will now be worth $110 million. And so this very simple mechanism naturally pushes up the price of a stock or an index that has exposure to foreign currencies. This is why when we look at all of the big declines in the US dollar that we've had since the financial crisis, all of them, with no exception, have been accompanied by a substantial rise in the S&P 500 index. So today we have three major financial variables: oil, interest rates, and the US dollar, that are all going in the right direction for the US stock market to perform well. And we actually backtested the number of times where we've seen the stars align like today. Going back to the 1980s, we've seen the same thing happen a total of 6 other times. And as you can see, in all cases, the stock market rose significantly in the months that followed. And just like 2024, these were key characteristics of the market melt-ups in the late 1990s and the 1980s. 2025 seems to be a continuation of this. When we zoom in on the short-term price action of the S&P 500, the index is retesting the 200-day moving average right now. Now, although there could be a brief dip below, just like what happened in October of 23, or in March of 23, we think this level has a good chance of holding and marking the bottom of this correction in stocks. Currently, we still have all of the moving averages pointing upwards on the S&P 500, which provides a very good foundation for the stock market rally to continue. If we rewind to the late 1990s, we can see we had the very same technical formation throughout the entire melt-up, with the S&P 500 coming back to these moving averages multiple times during this period, just like today, offering huge buying opportunities to investors that were willing to take the risk at these moments. Now, it could be that we're wrong and that the index makes a dead cat bounce and breaks back below the moving averages, that these begin to turn down, and that we begin a significant bear market. This type of breakdown is something that we'll be watching very closely to understand if we should be shifting our opinion on the market. The worst thing you can do as a trader is stay stuck on your opinions. The key to trading is having conviction, but staying flexible and open-minded. If you want to have access to all of our trades and learn everything that we know about financial markets, make sure to subscribe to our website and join our awesome community of traders.